Look, I need to have a frank conversation with you about investing after 50 because the framework that works when you are 30 doesn't work when you are 50 or 60, and a lot of people don't adjust their strategy appropriately as they age, which creates serious risks to their financial security in retirement. I'm Raoul Pal, and I've spent decades analyzing markets and advising institutional and individual investors, and one of the most important concepts in finance is that your investment strategy needs to align with your time horizon, your risk tolerance, and your financial objectives. Those parameters change dramatically as you get older. Before we dive into specific investments to avoid, hit subscribe because what I'm about to share connects portfolio theory, risk management, and life cycle investing in ways that are critical for anyone thinking about retirement. Here's the fundamental issue. When you're 25 or 30, you have 35 to 40 years until retirement. You can take meaningful risks, ride out bear markets, and recover from losses. Volatility is actually your friend because it creates buying opportunities when you're in accumulation mode. But when you're 50, 55, or 60, your time horizon compresses dramatically. You might have 10 to 15 years until retirement, maybe 20 to 30 years of total investment horizon if you're planning for a long retirement. That's still substantial, but it fundamentally changes the risk-return trade-off you should be willing to accept. The problem is many people don't adjust. They keep investing like they are 30 when they are actually 55. They take risks that made sense 2 decades ago but are completely inappropriate now. And when those risks blow up, and in markets, eventually concentrated risks do blow up, they don't have time to recover. Let me walk through 5 specific categories of investments that I think are particularly problematic for people over 50, not because these investments are inherently bad, but because the risk profile doesn't match the life stage. I see this constantly: people in their 50s putting 20%, 30%, sometimes 40% of their portfolio into a handful of individual stocks, often in high volatility sectors like tech, biotech, or speculative growth companies. The thesis is usually I need growth to catch up, or I found the next Amazon. Here's the issue. Concentrated positions carry idiosyncratic risk, company-specific risk that has nothing to do with broad market movements. A scandal, a failed product launch, regulatory action, competitive disruption, any of these can cut a stock's value by 50–70 overnight, and unlike market risk, which tends to recover over time, company-specific disasters often don't. When you're 30, you can afford to take that risk because you have time to recover. When you're 55, a 50% loss in a position that represents 25% of your portfolio means you have lost 12.5% of your total wealth. To recover that, you'd need a 14% return on your remaining portfolio just to get back to break-even. That might take 2 to 3 years or longer. The math gets worse. If you were planning to retire in 10 years with 1 million and you lose 125,000, you now need to save more or work longer or reduce your retirement lifestyle. None of those are good options. The alternative isn't avoiding stocks, it's diversification. Broad market index funds give you equity exposure without company-specific risk. You participate in market growth without betting your retirement on whether one CEO makes the right decisions. This includes cryptocurrencies, speculative options, strategies, leveraged ETFs, penny stocks, anything that can realistically lose 50–80 of its value in a short period. Now, before people get defensive, let me be clear. I'm actually bullish on Bitcoin and digital assets long term. I've been very public about that. But there is a difference between having a 5% allocation to Bitcoin as part of a diversified portfolio and putting 30–40 of your retirement savings into crypto when you are 58 years old. Bitcoin has dropped 70–80 from peak to trough in multiple cycles. If you're 60 years old and you need to start drawing on your portfolio in 5 years, can you afford to have a third of your wealth drop 75% right before retirement? The timing risk is enormous. The same logic applies to leveraged ETFs, which are designed for short-term tactical trading, not long-term holds. They experience decay over time due to daily rebalancing, or option strategies that can go to zero if the market doesn't move exactly as you predict within a specific time frame. These aren't appropriate risk levels for someone who can't afford to recover from catastrophic losses. If you want crypto exposure, keep it to 3–5 of portfolio. If you want to use options, use them for defined outcome strategies like covered calls or protective puts, not speculation. This includes certain private equity investments, non-traded REITs, structured products with long lock-up periods, and even real estate that you've over-leveraged or that's in a declining market. The problem with illiquidity when you're approaching retirement is that your need for liquidity increases. Healthcare emergencies, family needs, changes in retirement plans, you need flexibility. If your wealth is locked up in investments you can't access without massive penalties or losses, you've created a serious vulnerability. I see people in their 50s and 60s putting significant portions of their portfolio into non-traded REITs because their financial advisor pitched them on stable income and diversification. But these products often have 5 to 7 year lockups, high fees, and limited price transparency. When you need your money, you can't get it, or you can only get it at a massive discount. The same issue applies to over-leveraged rental real estate. If you're 55 and you've put $200,000 into a rental property and taken a mortgage, you've created a concentrated illiquid position. If the market turns or you have a bad tenant situation, you can't easily exit without taking losses. Liquidity has value, especially as you age. Maintain it. This includes certain variable annuities with 2-3 annual fees, actively managed funds that charge 1.5% expense ratios while underperforming, and complex structured products with embedded fees you don't fully understand. Here's the math. Over 20 years, a 2% annual fee differential compounds to roughly 33% less wealth. If you're 55 with $500,000 and you're paying an extra 2% in fees annually, by 75 you'll have roughly $165,000 less than if you'd used low-cost index funds. That's not theoretical, that's real money that could fund your retirement. Instead, it's funding someone else's commission and management. Fees. I'm not saying all financial advice is worthless or that all managed products are bad, but you need to understand exactly what you're paying and what you're getting for those fees. If someone's charging you 1.5-2 annually and you're getting market-matching returns, you're overpaying dramatically. This is when people in their 50s or 60s make large, concentrated bets based on a specific macro view. The dollar is going to collapse, so I'm putting 50% into gold, or real estate always goes up, so I'm buying 3 rental properties, or interest rates are going to zero, so I'm leveraging into bonds. Macro predictions are notoriously difficult even for professionals, and when you concentrate your portfolio based on a single view, you're taking on enormous risk that your thesis is wrong or that the timing doesn't work. I have strong macro views, I share them regularly. But I'd never suggest someone bet their entire retirement on any single macro thesis. Markets can remain irrational longer than you can remain solvent. Even if you're ultimately right about direction, you can be wrong about timing in ways that destroy your portfolio. The solution is diversification across scenarios. You hold assets that perform in different economic regimes: growth, inflation, deflation, stagflation. You construct a portfolio that's robust to multiple outcomes rather than fragile to any single path. So those are 5 broad categories to be cautious about if you are over 50. Concentrated stock positions, speculative high volatility assets, illiquid investments, high fee products, and undiversified macro bets. Now, what should you be doing instead? Here's my framework for people approaching or in retirement. 1. Build a diversified core. 60-70 of portfolio in broad market index funds, domestic and international equities, investment-grade bonds, maybe some REITs for real estate exposure, low fees, high diversification, liquid. 2. Include some inflation hedges, gold, commodities, maybe 3-5 in Bitcoin if you understand it and can stomach the volatility. These are insurance positions, not speculation. 3. Generate income sustainably, dividend-paying stocks, investment-grade bonds, maybe some preferred shares, structure withdrawals at 3- for annually. 2. Balance longevity risk against return needs. 4. Maintain liquidity. Keep 1 to 2 years of living expenses in cash or short-term bonds. This prevents forced selling during downturns. 5. Rebalance systematically. When equities run up, trim to targets. When they sell off, buy. This forces disciplined buying low and selling high. This isn't exciting. It won't make you rich overnight, but it's designed to preserve wealth, generate reasonable returns, and minimize the risk of catastrophic losses you can't recover from. The key insight is this: after 50, your primary objective shifts from wealth accumulation to wealth preservation with enough growth to maintain purchasing power. You're not trying to hit home runs. You're trying not to strike out. That requires a different mindset. You need to be more defensive, more diversified, more cautious about fees and taxes, more focused on sustainable income rather than capital appreciation. Does this mean you can't take any risk? No, you still need equity exposure for growth. You still might allocate small portions to higher risk or higher return opportunities, but the sizing and the risk management need to be appropriate for your stage of life. The worst outcome is being 70 years old and realizing you made investment decisions in your 50s that permanently impaired your retirement lifestyle. That's the scenario we're trying to avoid. If this resonates, leave a comment about where you are in your retirement planning journey. Share this with anyone over 50 who's thinking about these issues, and subscribe because we're going to keep discussing intelligent portfolio construction for different life stages. The goal isn't to make you fearful, it's to make you thoughtful. to help you align your investment strategy with your actual situation rather than with some generic advice or with strategies designed for people half your age. You can build a portfolio that gives you growth, income, security, and peace of mind, but it requires adjusting your approach as your circumstances change. That's not conservative, that's intelligent. Position accordingly.